Hi, welcome to another episode of the Trading Rooms Podcast. As always, I'm your host, Raghu Kumar from Rain Platforms. In episode 28 of the podcast, I had interviewed Dr. Ernie Chan, and we had discussed the topics of machine learning and trading. Dr. Chan holds a PhD in theoretical physics, and today, in episode 30, I got to interview another personality with a PhD in theoretical physics, Dr. Euan Sinclair, who is a partner at Talton Capital Management, a volatility hedge fund. Dr. Sinclair also holds, as I mentioned, a PhD in theoretical physics. Dr. Sinclair has more than 20 years of experience in professional options trading, and he's also a founder and CEO of copilot.ai, which is a developer of AI-based chatbots, and he's a consultant at Bluefin Trading. As I mentioned, he holds a PhD in theoretical physics from the University of Bristol, and he's also written two books, Volatility Trading and Options Trading, both published by Wiley, as well as numerous papers and articles. We will include links to both books in the description of the episode. In this interview, I got to ask Dr. Sinclair a whole bunch of questions on a wide variety of topics. We talk about his experience in trading options over the years, how he gained experience as a market maker in DAX and Eurostoxx options, how one should go about thinking about trading volatility, and how we should make sense of the efficient market hypothesis, and a lot more. What I kind of walked away from in this interview was a much greater appreciation for Dr. Sinclair's ability to break down his approach to trading or to generating alpha into two relatively basic concepts, which he expounds upon a lot in this interview. Here's my interview with Dr. Euan Sinclair from Talton Capital Management. Before that, a quick note. This episode is brought to you by Trading Rooms, India's first automated social investing and trading platform. Check out Trading Rooms at www.tradingrooms.in. So without further ado, here's my interview with Dr. Sinclair. Thank you. So welcome to the podcast, Euan.
Thank you. Nice to be here.
Great. So, I thought we could start with just your general background, for those guests who are not familiar with your background and story. Could you kind of, quickly maybe introduce yourself, and then, how did you get into the world of options trading?
Okay. I grew up in New Zealand. I went to undergrad in New Zealand. Then I left to do a PhD in theoretical physics in England. And at the time, I thought I was going to be, the plan was always to be a physics professor. Like, as long as when you're a little kid, you don't know about any jobs, but as long as I knew that there were jobs you had to go to do, that was my plan. And during my PhD, I found two things. First, I didn't like most of what it was that academics did. I wasn't particularly enamored with teaching, and I didn't want to spend all my life applying for grants, supervising students, marking exams, giving homework. It's the research that people get into the idea from, but until you're a superstar, your life isn't really all research. In fact, most academics are trying to get that research in around other things. So I wasn't particularly interested. And also, I wasn't really good enough to end up in the sort of institution I wanted to be in. I could have got a job. I could have eventually ended up as a physics professor at some, I don't want to mention a university because I don't want to sort of make it sound like it's a second tier thing, but, some state college in the US, or, one of the universities in England that isn't Oxford, Cambridge, or London. But I didn't really want to go down that route. And also the postdoc route you have to go through first is a very unstable, unpleasant thing. You're typically these days looking at 3 to 4 postdocs at least, where you never know where you're going to be living. You're massively underpaid. None of it really appealed. And so I started looking around for something else to do. And at the time, this was in 1995. So Nick Leeson had just blown up Barings Bank, which was probably the first time most people in England had heard of derivatives. It doesn't really have a very high public profile there, as it would in, say, the US. So after that, it became big news to the point where physics publications were mentioning it, talking about how the banks were hiring physicists to be quants and rocket scientists. So I thought that could be an avenue that would be worth pursuing. And at that point, I sort of got lucky because I didn't have any idea. And you got to remember as well, the internet was around, but it wasn't like it is now. You can't just go and click on, I don't know, some careers website and find out what everything is and what these firms are and what they do. So there's really no visibility into the finance world unless you know someone in it, which I didn't. So I didn't know the difference between being a broker, a salesman, a quant, a programmer, risk manager, trader. To me, it was all just you worked in a bank. And I didn't even know the difference between trading firms and banks and brokerages. So I interviewed with a bunch of these places, and I just ended up in the place I did because I liked the people there the most. So it was really down to me making a very lucky but ill-informed decision. I could quite easily have ended up as a quant at one of the big-name American banks or a big hedge fund. It just didn't turn out that way. And I think, looking back, it was good for me that it did go the way it did. I've quite enjoyed my career so far.
So where was that first institution that you worked at? I didn't get that name.
At the time, it was called Apollo Derivatives.
Okay.
I say at the time because it changed its name a bunch of times afterwards as various partners came and went. And it was an options market making firm which had it started in Chicago, had operations on the floor, moved to London, had operations on Life, and then started trading Eurex electronically. So I was on the Life floor for a few months just learning, because it's easier to sort of have someone train you down there, ironically, given the chaos that it is. And then I went upstairs and I was doing the Eurex after that.
Right. So my next question has to do with your background in theoretical physics, because I interviewed Dr. Ernie Chan, on the episode before the last one, and he's also a PhD in theoretical physics, and of course he's the one who introduced me to you, and we discussed this on that podcast as well, how his background in theoretical physics eventually impacted, his future in trading. In your case, how do you think that played out in terms of your background in theoretical physics? How do you think that helped you or shaped your career as a trader in any sort of way?
I mean, in a technical sense, I don't think it helped at all.
Okay.
Obviously, theoretical physics is a big field and trading is a big field. So there were some of the people I was at university with, some of my friends who were doing computational dynamics. That would have been a huge help, because you're working on learning real programming, writing real programs in C++, doing big simulations. But I wasn't doing that. I was doing pretty old school equation manipulation type things. And that really doesn't help. And I think it's I think it's ridiculous that there are still MFE courses that are teaching stochastic calculus to students. It's garbage. It doesn't help. It's a complete waste of time. It's not even, it's useful to know. It really isn't. All the stuff that can be solved that way was solved 30 years ago. That is a complete waste of time. And the only reason it's taught is because the professors, that's what they know. So I think had I learned computing, had I learned statistics, I didn't learn statistics. So even experimental physics would have been more useful. But luckily at the time, the people who were employing you didn't know anything either, because they knew that they needed quants. There were no MFEs. There were a few, economist graduates who'd studied derivatives, but not many. It was a pretty niche field in academia. So they just basically went out and found numerate people. So on a technical standpoint, it didn't help me at all. It taught me how to do research.
Right.
And I think people think that's much easier than it is to learn that mindset. And that's what a PhD is. It's 3 years of learning how to do research and how to think.
Right. Right.
Probably could have learned that doing a history PhD.
Right.
So,
sure.
I don't really know how Ernie trades, and I don't really know what he did his PhD in. Like I said, it's a big field.
Right. Right. No, I mean, obviously in his case, he probably used some of that towards building some of his, machine learning models. I'm not sure. But one reason I do ask that question is because, a lot of our listeners are not full-time traders, right? They're kind of coming in from the outside, whether they have full-time jobs with a work designation, which has nothing to do with trading, or they're in academia or whatnot. So, one question I get asked a lot is, how should someone who's not a full-time trader think about trading as either a part-time or maybe even a full-time activity? How should they maybe segue into that? Did you have any thoughts on that?
I think the first thing they have to do is treat it like a hobby to start with.
Right.
Like, instead of playing, I don't know, fantasy baseball or whatever, start trading. You can trade very small now. There are plenty of micro brokerages that let you trade fractional stocks. You don't have to trade big. If you can't make money trading $1,000 account, you can't make money trading $1 million account. There's this idea that there's advantages that small customers have, and it's massively overplayed. Most of the people who'll tell you that are people who are trying to sell something. Small people have almost no advantages. There are sometimes things that they will be able to do that an institutional person just won't bother to do.
Right.
Because, there's plenty of trades I could do where I could make $5,000 a year easily. But honestly, what's the point? It's just a distraction. So there's that,
Right.
but I wouldn't call that an advantage. I'd just call that can't be bothered on the pros side.
Right.
And that actually leads me to one of the big mistakes that retail traders make. They mistake liquidity or illiquidity for an edge that they have over the pros. They'll be like, well, the professional's not playing in this because the market's really wide and there's no liquidity. But that applies to them as well. You've got to get out of this trade, and you don't have any magic ability. If the market's one bid at 5, you might get lucky. You might sell it at 4. But you have absolutely no magic ability to be able to buy it back for anything less than 4. So the spread is for everyone. And the market makers aren't going to do you a favor by making that spread narrower because they just don't care. And there's a reason that spread is that wide. So I would say start as a hobby, start small, learn real techniques based on actual sort of business ideas that might make money.
Yeah.
People kind of think trading some magic thing where you can just do some quant analysis or draw some lines on a graph and make money. But it's like any other business. You'll only make money if you're providing a service to someone. So ask yourself, why would I take the other side of the trade you're doing? What's in it for me? What service are you providing me? And there are plenty of situations where that is an obvious thing. But, if you come to me and tell me you're going to draw lines on a graph and you're really smart, that's not a business plan. You wouldn't do that in any other business. If you were going to open, I don't know, a tech business and you wanted me to be an investor, you wouldn't come to me and say, I'm really smart and I work hard. Right. You're like, well, that's a given. What are you going to do? What's your business plan?
I think
that's the first thing.
Yeah, I think with trading, that's usually not how most traders think about it. in terms of asking that question, what service am I providing? But I really like that because, everyone has a role to play in the markets, right? And once you kind of understand what your role is, whether it's at the retail level or if you're coming in, at the institutional level, everyone has a role. And once you kind of know who you are, then you can probably figure out what service you're providing, right?
See, that's the big advantage that pros have over retail. If
Right.
you're a pro, you don't decide what your trading strategy is, and you don't
Right.
decide what you're going to trade. It's like you're an options market maker. Sit down there and make markets in these options.
markets,
That's what you do.
right.
And I'll teach you exactly how to do it. You do exactly what I say, and eventually you'll be profitable. Whereas the retail people are sort of looking from the outside and they're trying 1,000 different things, and sometimes they work and sometimes they don't, and sometimes the things that work are just luck, and they're sort of trying to reinvent the wheel in a lot of ways.
Right.
So it's a more interesting thing. As a hobby, it's much better,
Right.
but it's less likely to work.
Right. So I wanted to kind of touch upon market making since you did bring that up. And obviously you have a lot of experience as a market maker. And what I really appreciate about your story is that, and we talked about this on our previous chat, is that you spent a lot of time, as just a market maker or at the institutional level. And then eventually, of course, you started up your own fund. But you have a lot of discipline, which you've kind of accumulated over the years in just doing that one task, like you said. So I did want to talk about market making a little bit. In terms of market making as a role, right? How do you think market making has kind of shifted over the years, and why do you think there's such a large kind of negative rep associated with market making? I think for the average retail participant, and I'm sure a lot of our listeners can probably attest to this, they don't think of the market maker as being like a good dude, right? They generally think of the market maker as being like this person who's just out to get you, and they'll do whatever it takes to get you. Where do you think that comes from? And then kind of related to that is how has market making kind of evolved over the years?
Okay, I've got a book that was written in 1905, and it's about options market making. About someone who was making markets and options in the Royal Exchange in London. And what he did is completely recognizable to any options market maker today. The theory and the strategy hasn't changed much at all. What has changed is the technology and the market structure. So this guy, Mr. Higgins, was making markets in like one or two stocks, and he'd make about 10 trades a week. Whereas now, if you're doing equities, you'll probably be making markets in 300 stocks, and you'll be doing thousands of trades a day. That's very different, but the actual techniques haven't changed a great deal, in the same way that running a shop hasn't changed a great deal either. The logistics of getting stuff in, big difference. You need a website, big difference. But what you're really doing is you're buying something at wholesale and selling it at retail. As to why people think market makers are out to get them, I think there are two reasons. First, people don't want to take responsibility for their own trades. People want to assign anything good that happens to their own ability and anything bad that happens to someone else's fault. It can't possibly be them making a mistake. So the person they are directly interacting with these days is the market maker. You're not dealing with a human broker anymore in most cases. You're putting an order into your trading platform, and you see that it's a market maker on the other side. And so I think there's that kind of desire to blame someone else. But there's also a big misconception about what market makers can do. And there's this idea, I hear it all the time, that market makers pushed this stock higher so all their options would expire worthless. Well, there's about four things wrong with that statement. And the big one is market makers can't push anything anywhere. Market makers are at the mercy of all the order flow that's coming in. So it might be institutional, but sometimes it's just retail on the other side of you in a big size. like what happened with the meme stocks. And the people who got really sort of lost all the money in that were market makers. So, I mean, you don't have to love the market makers, but if they weren't there, you're not trading. I mean, so market makers treat you as badly as, I don't know, a supermarket. You know, they're running a service. They buy something lower and they sell it higher. And if you think it's such an easy job and you think they're out to screw everyone and they push the markets around, you're more than welcome to become a market maker.
Right.
I mean,
and good luck with that, right?
Yeah. I mean, is it impossible to do? No, but it's a very difficult job.
Right.
It's not easy. You're not guaranteed to make any money.
Yeah. And what I really appreciate about what you said earlier was, again, you know, when you kind of understand what service you're providing, then you can also take that one step further and you can figure out what is the service that the counterparty is providing, right? So in the case of a market maker, what are they really doing? And once you kind of understand what a market maker does, then maybe some of those misconceptions can kind of, you know, can go away. But I want to kind of switch gears now to how you eventually got into buy side trading, right? So you basically were a market maker for I think like decades, right? And then you kind of switched over to starting up Talton. And obviously you have more than 25 years of options trading experience. And so you've been trading options for a long time. How did your approach to trading options kind of shift, you know, once you switched over from market making to trading options, you know, through buy side trading?
Okay, so I think my evolution was I was purely a market maker for maybe 5 years. Then I ended up doing quant support for market making. I designed like one of the earliest automated market making systems. So I did a lot of thinking about the process of market making. And I was always in a market making firm. I was in a market making firm for like 12 years. And eventually I ended up doing risk management for the options group. And one of the things I needed was a separate way of evaluating whether a trade was good or not. Because I couldn't just look at what the traders have done and what they think is good. I had to have a separate way of saying, look, I actually think this position's big, but it's a good position, so we should keep it. Whereas this one I think is a terrible position, so we should take it off. So to do that, I had to have some sort of independent view of what the price of each option should be. Mm-hmm. So that was what got me thinking about actually trying to find proactive edges you could get in the market as opposed to just being a passive market maker. So market makers are very good at managing risk because options contain a lot of risks, and making money as a market maker is the easy bit. Because if I'm making a bid on an offer, I get hit on the bid, I get lifted on the offer, that's money. Keeping it's really hard. But what market makers don't have a good idea about is how to find edge, because they're given the edge. The edge is what they start with. Whereas if you're a positional trader, you actually have to go out and find situations where options will be systemically mispriced. So that's the big difference.
That's the big difference. Got it. Yeah. And obviously, you know, you've been, again, trading options for decades now. So I got that part correct. And, and when it comes to, you know, building an option strategy, right? How do you kind of think about that whole process of building a strategy which you can get behind and then, you know, hopefully trade for a long period of time in a ideally, you know, consistently profitable manner? How do you think about that whole process of building an options trading strategy?
Okay, so I think I'm going to come back to my having a business plan analogy again.
Yeah.
You've got to base it on the idea that you're doing something for someone else. So if I'm trading an option with you, I can't just assume you're stupid and you're making a mistake. And I think that's one of the problems a lot of retail people have. They're like, I make money because other people are dumb. Other people, well, you know, obviously a lot of other people are dumb, but the markets aren't. So you've got to ask yourself, why is this other person giving me this trade? What am I doing for them that makes it worthwhile them paying what I think is the wrong price? So that's the first thing you have to think about. And with options, the big thing is the variance premium. The variance premium is like gravity. You might not like it. You might want to be able to fly, but the variance premium is there. It's a real thing. And basically, it just means options are usually overpriced because they're an insurance product. All insurance is usually statistically overpriced. And so by selling options, I'm providing that service to the counterparty. They want insurance. They don't want a certain risk. They're prepared to pay me to take that risk for them. So risk premia should be, I think, the backbone of any trading strategy. There are other things you can do around that. There are special situations you can look for, like what happens around stock splits. What happens when a pharmaceutical company announces a new drug? What happens around elections? These are all things you should be trading, but they don't happen often enough to form an entire professional operation.
Sure.
So it's kind of like a food pyramid.
Right.
I think the basis of whatever you're doing has to be a risk premium. And the great thing about risk premia is they tend to be so strong that the exact details of how you monetize it aren't super important. They're important, obviously, everything is. But that's not what will make or break you. So with options, if you sell iron condors, if you sell straddles, if you sell strangles, if you delta hedge, if you sell VIX contracts, all of these things over time make money. And it's another problem. Retail options traders get hung up on, should I do an iron condor? Should I do a butterfly? Should I do a strangle? Professionals don't even care. They just, I want to be short volatility. That's it. I mean, and after that, the way I do it is so minimally important. Whereas a lot of retail people think there's edge in choosing the structure. And they're kind of sold that by people, again, I wouldn't call them scammers, but bad teachers who harp on about the structures. They talk about the Greeks all the time. Like the Greeks are a source of edge. Like if you know about gamma, you can make money. I mean, the Greeks they're like the instruments in a car. It'll tell you what's happening, but it's not going to tell you how to drive better.
Right.
So
you got to figure that out yourself.
There's no edge in the Greeks.
Right. And the Greeks themselves, exactly.
And I think that's a lot of retail people get that wrong.
Sure.
I mean, a lot of pros don't really understand that either.
Yeah, no, I really like that analogy to insurance because I think that makes a lot of sense in terms of why, options are overpriced. But, how does one actually take advantage of that fact, right? Like, again, to our listeners, if someone hears that and they kind of make sense of it's like, yes, options are like insurance and yet, and that's why, they tend to be overpriced. How does one take advantage of that fact and maybe build an option strategy around that idea?
Okay, so one of the mistakes people can make is by conflating usually with always. Right. Usually options are overpriced, but they are not always overpriced.
Right.
So the first thing you really need to do if you're going to make significant amounts of money by selling options, it's not to focus on risk. I mean, I'm not saying risk isn't important, but come on, that's a given. If you can't figure out you want to protect against a market crash, I can't help you. That is obvious. And again, it's one of those things that people will tell you as though it's some sort of magic. It's not. So if you're selling a 30 delta strangle, go and buy some 2 delta puts so you limit your losses. But again, there's no magic in that. If you can't figure that out, I can't help you. Sure. What you have to do is figure out situations where options are overpriced. So there are these special situations like around elections, around earnings, around any sort of source of uncertainty. Options are almost always going to be overpriced. Ask yourself, wow, do I want to buy options here? Because if your gut feeling is telling you want to buy them, that's when they're overpriced.
That's when they're
Because
overpriced, right?
everyone's thinking that. Everyone's like,
Right.
wow, the stock could move a lot over earnings. Why do I want to sell it? You just told me why you want to sell it.
Right.
So you have to look for systematic situations where things are more likely to be mispriced. And that's one of the unfortunate things about options is it's hard to test stuff because options data is expensive, difficult to use. There's a lot of it. It's difficult to manage. But that's really the best way to find something that works. Or you can just read my book. You know?
Well, I mean, we are going to include a link to the book in the description of the episode. But I want to kind of touch upon a couple things here. So you touched upon this idea earlier about how, you know, the retail trader actually has the ability to maybe kind of you know, take advantage of opportunities that a institutional desk would probably never go near, right? Because of just, you know, perhaps due to scarce liquidity or whatever the reason is. And so kind of expanding upon that and then kind of thinking about what you just said right now, which is, you know, there are these opportunities where you can think about, you know, is the option overpriced right now due to, you know, heavy demand, right? Or whatever it is, you know, maybe during election season or whatnot. How does one actually know if the option is overpriced? I know this is probably like the $1 million question here, but just generally, are there tools that a retail trader can specifically use to know whether, you know, say it is a very volatile, you know, time of the year or whatever, or day, for, you know, for that matter, for them to kind of take advantage of that situation and then look to, you know, sell options?
Yeah. Okay. So there are two things going on there. The first
Yeah.
one is understanding the reason why options would be overpriced.
Right.
So like the classic one I'm going to come back to is the stock's about to announce earnings. Half the people think it's going to go up a lot. Half the people think it's going to go down a lot. Combining a positive mean and a negative mean effectively flattens out your distribution. It has the effect of making the distribution wider. So both of these groups of people may agree with what volatility is going to be. They may all think volatility is going to be 20%. But because one of them thinks the jump's going to be higher and one thinks it's going to be lower, the implied volatility might actually be 40. So that's a plausible situation where options are going to be overpriced because of divergence of views. So you start there. Then there are a number of services on the web, which I don't want to recommend, you know, because I just don't want to get into the business of recommending stuff that I don't use. I mean,
Sure.
because I don't want to get blamed. That provide like historical implied volatilities and historical realized volatilities. And you can look to see the spread between those two is normally 6 vols. Right now it's 12. That might be a good place to get in. It might not be. If you can't see a reason why that would be true, maybe it isn't. But if it's like a wide thing and you're like, oh, because people think this is about to happen, Apple's about to announce a new iPhone or something, then that's sort of what you go for. The big warning I will give you on that one is there are plenty of things that seem like they should be predictive that aren't. So the earnings example, you can't look back at the last 4 years worth of earnings and say the average stock move was 4%, the biggest one was 8%. That doesn't mean anything. You think it would, and it's perfectly fine to think it would, but once you've done all the tests, it doesn't. So that's one of the things to be aware of. Just because you think it's plausible doesn't necessarily mean it's going to be there. So some of that's written down.
I didn't exactly get that. So if I'm looking at, you know, say historical earnings for say Apple, right, and I'm noticing a certain pattern in terms of actual earnings versus expected earnings, and then and I kind of devise some sort of a system based around that. why couldn't I use that as a way to build a system into the future?
Oh, no, I'm not suggesting anything that complicated.
Oh, okay.
Although I would say the reason you can't do that is because every analyst at every investment bank's trying to do that and it doesn't work.
Okay.
I mean, that's one of those things that I would say it's a game that you shouldn't be playing as an amateur. Because there is a chance you'll be better than the guy at Goldman Sachs. A small chance. But if you are, it's still going to give you such a small edge, it won't even matter. It's so much work with such limited upside. Now, what I'm saying is you look at the last 4 years worth of Apple earnings announcements and you just look to see what the stock did that day. So if the average move of Apple when it announces earnings is 4%, you could look at that and go, that is actually what happened. But that is not predictive of what's going to happen.
Right.
It is practically meaningless going forward.
It's meaningless, right.
Yeah, it's for a start, 4 years ago is almost irrelevant now in the lifetime of any company. Things happen so quickly.
Right.
But there's also just a lot of randomness. The stock was going to move, probably 1.5% that day anyway.
Anyways, exactly. Right. Yep. Makes sense. I wanted to also kind of expound upon something you wrote in one of your books, and I picked this up from one of your blog posts, and it has to do with, something we've all been taught, which is the efficient market hypothesis, right? And the exact quote is from your book, Positional Options Trading. And the quote is, "The trader's concept of the efficient market hypothesis is making money is hard. This isn't wrong, but it is worth looking at the theory in more detail. Traders are trying to make money from the exceptions to the EMH, and the different types of inefficiencies should be understood and hence traded differently." I was wondering if you could kind of expound upon this, because it seems like there's kind of two different things going on. One is the markets are efficient at some level, and yet it's also obviously worth it to pursue trading the markets, right? If you kind of know what you're doing, obviously. And so I guess my question is, how does one reconcile those two statements?
Well, the first thing to realize is the people who invented the efficient market hypothesis never thought the markets were perfectly efficient. Eugene Farmer said markets can be considered efficient if you're within 50% of the true value. So that's an awful lot of wiggle room. And it also means on average, they tend to be fairly priced. At any given moment, they might not be. And they also knew that the mechanism that pushed markets back towards efficiency was traders taking advantage of these momentary inefficiencies. So those two aren't really in contradiction. So I find it's a good way to notice if people really understand the efficient market hypothesis. If they say something like, of course the markets aren't efficient. Look at Tesla. I mean, that means absolutely nothing. It means you don't understand what you're talking about.
Exactly.
There are, within that 50% wiggle room that you've got, there are two main ways that markets might be mispriced. The first one is there is a risk premium. Like I said, people are prepared to pay to eliminate a risk. So you've got the variance premium there. You've got other risks that are smaller, skew premium, correlation premium. Those are the sort of inefficiencies that are based on a psychological/economic argument that's always going to be there. People are always going to want to avoid risk. So taking the risk on the other side, that can be the basis for your trading strategy. But the other thing is sometimes there are just inefficiencies because the market hasn't adjusted yet. And you'll often find that in structured products where you find you can replicate the structured product for less than the total value of the single thing. So there might be a covered call ETF that consists of S&P futures and it's short a call. And you find that you can replicate that cheaper using each individual instrument. Now, a lot of inefficiencies like that aren't available to retail because they involve too much high frequency monitoring. The edges are so small that you have to do it with massive amounts of capital to make money, the costs and so forth.
Right.
But the idea, you can start with that idea. And like, it comes back to, why is this money there? Like, I had someone recently tell me they thought Tesla was 88% undervalued. Okay, so leaving the fact that I think that's crazy on every level.
Right.
There is no way that there is an 88% edge sitting out there available to anyone with a brokerage screen. Markets are not that inefficient. And normally when there's edge, it's because there's something difficult to do. It's like you have to sell options. You don't want to do that. It's uncomfortable. It's difficult. You have to put on this very complicated spread trade to lock in this arbitrage. It's difficult. You're not going to find free money sitting around there. Right. So if I price an option and I think it's 10% overvalued, I'll believe that. If I think it's 200% overvalued, I've missed something.
Yeah, you missed
the
something. The
markets aren't that easy.
Right.
Yeah.
Right. No, it makes a lot of sense. I also wanted to kind of talk about just, the concept of trading volatility, right? Because obviously, Talton seems to be a hedge fund, which kind of generates most of its alpha through trading volatility. So how does one even think about that concept of trading volatility? Like what exactly does that mean? And, at the retail level, since most of our listeners are listening at the retail level, how should one think about the idea of trading volatility?
Okay, well, there's a lot of mathematical stuff talked about when it comes to volatility. Mm-hmm. There's a lot of mathematical stuff talked about everything in trading, right? And you should never start with the mathematics. The mathematics are a tool for analyzing a phenomenon that you can actually just look at. Right. So there are two things in a stock price. There's a trend, and then there are wiggles around the trend. That's it. Then we have to start quantifying those things so we can actually do statistics on them. That's the only reason. Trend and wiggles, that's all we know about. So we happen to quantify the wiggles, the deviations from the mean, in terms of a standard deviation measure, because it's easy to do math on a standard deviation. That's it. Mm-hmm. Again, going back to this idea of, normality of stock returns, that's the reason people did it. No one's ever thought stock returns were normally distributed. It's one of those things people misunderstand. That's not a gotcha. And that wasn't something that someone discovered 10 years ago. And traders before the 1987 crash knew that too. Everyone's always known that. But mm-hmm. you can do good math with a standard deviation. So technically, the volatility is the standard deviation of the moves of the stock. So mm-hmm. standard deviation of, for example, daily price moves. So to trade volatility, you put on a directionally neutral option position that is either agreeing with that or disagreeing with that. Because the options themselves will give you a forward-looking view of how much the market expects volatility to be. And mm-hmm. the simplest example of that's a straddle, right? If the straddle is worth $1, that's telling you people think the market's going to move more than $1, or it's going to move $1, because that's the fair mm-hmm. price. People are buying and selling at $1. So if you think the market's not going to move $1, well, you sell the straddle. That's volatility trading. It doesn't matter if the market goes up or down. What it matters is it goes, well, in this case, that it doesn't move.
Right.
So you're betting on move size, not direction. And that's something, you don't need an option pricing model to do that. I mean, I just told you how to do it. You can use an option pricing model, but it's not necessary. You can trade volatility without knowing anything about option pricing. You can just look at the straddle and say, no, I don't think it's going to move that much. I mean, that's a perfectly legitimate way to trade, to be honest.
Where's the risk associated with that trade? So let's assume I do take that trade, that, I take that straddle trade, and you're basically taking that trade based on the size of the move, right? That's what you said. Where's the risk associated with the trade?
Well, once you sell a straddle, in that case, you sell it for $1.
Mm-hmm.
If the stock moves $15, you're going to lose $14 because you took in $1 of premium and the stock moved $15.
Mm-hmm.
That's your risk. The risk is that you have limited upside and unlimited downside.
Right.
And that's, again, another reason why there's an edge to selling that, because people think I've just described a terrible situation. But that doesn't matter as long as you win a lot more than you lose.
Right.
So it's the total expectation that's important, not the number of wins and the number of losses, or the size of the wins and the size of the losses. And conversely, if you're long the straddle, well, the most you can lose if you're long the straddle is $1. But, you're going to lose $1 an awful lot of times.
Sure. Now, it seems to me that there are a lot of these types of options trading strategies, right? You mentioned, trading iron condors and straddles, and there's strangles and all these different types of strategies, which I'm actually not super, well attuned with. But the general concept there seems to be, it becomes more about managing the trade, right, versus the actual trade itself. Like, a lot of them seem to have a kind of built-in positive expectancy, right? Provided you're selling the option when it's relatively overpriced. So it really comes down to managing the trade, right? Correct me if I'm wrong here, versus the actual trade itself. Is that right?
If you're talking about this as a professional, where you're dynamically delta hedging and playing off because you're taking in other options and selling out other options as a market maker all the time, then it's entirely management. Mm-hmm. If you're doing this as retail, say I sell a condor,
mm-hmm.
and that's the important part of that trade right there, the edge. Where people get, again, confused is they think there's an idea of position repair. So the market moves a certain amount. This is what you do to your trade to make it better. It doesn't matter what you do to the trade. The trade that's in the past.
Right.
You can't repair a trade in a way that you make that money back. The important thing at any time is, do you want to be short volatility or long volatility or flat? So a perfectly good way, if you want to be short, you can just sell a condor, come back the next week, sell another one when it's expired, and do that every week. That's perfectly fine.
Sure.
Again, a lot of things about options, people get hung up on the thousands of things you could do rather than the one really important thing you have to do. Right. If you are selling things that aren't overpriced, or you're buying things that aren't underpriced, I don't care what else you do. That's a crappy career. Right. That is not going to make you money in the long run.
Doesn't matter what you're buying or selling.
So it's like you can't. Right, you can't manage your way out of a bad trade.
Right.
I mean, if you really think you can, go and play roulette at a casino and manage your way out of that. It's like sometimes people will say, it's all about confidence. It's not about confidence. It's about statistics. Again, why don't you confidently play the lottery?
Right. No, the reason I asked that question is because, in India especially, there are a lot of retail traders trading these strategies, right, in the options market, trading, all these different types of iron condors and straddles and strangles and delta hedging and trying to take advantage of, options decay. And so it just becomes interesting to see, if everyone's kind of doing the same thing, where is the edge? And then what are they really doing, right? So I think that answers a lot of the questions right there, what you just said. So kind of switching gears a little bit here.
I think it's important to note that people can do a good trade for the wrong reason.
Right.
So a lot of these people are doing this trade because they think they're going to collect theta. They think theta is their edge.
Exactly.
Theta is not an edge. I mean, I know that time's going to pass as well. The only edge is if volatility is overpriced. Right. So a lot of these people are doing the right trade for the wrong reason. they would do better if they understood the reason, because they wouldn't just blindly do it all the time. They wouldn't do it in times when it was going to be bad.
Right.
But,
Sure. Yeah. So, switching gears a little bit here, I did want to kind of touch upon this topic a little bit. So this is something, Dr. Chan and I kind of talked about, actually, quite a bit on our podcast. We talked about machine learning, right? And just wanted to kind of get your thoughts on the emergence of machine learning, because obviously you do have a hardcore physics background, and I wanted to kind of see where you thought machine learning was kind of, headed to in terms of how is it going to impact the stock markets, and do you think people can actually meaningfully apply machine learning towards their trading strategies as it stands right now?
Yeah, okay, so sometimes people will say they can put a man on the moon, but they can't get buses to run on time. The important thing there is they means NASA. NASA can put a man on the moon. So machine learning's like that. Ernie Chan can make money with machine learning. Someone who's watched a few YouTube videos or got a package in Python or has done one class and a master's, they can't make money with machine learning. I mean, machine learning is only really adaptive nonlinear regression. It takes inputs, it gives you outputs because of the relationships between the two, and it changes things, but that's all it is. So it's garbage in, garbage out. So I think the problem with machine learning isn't that it's not a good technique. It's a fine technique, but so's regression, so's Taylor series, so's Garch models. There are tons of decent things, but if you think your edge is going to be because of machine learning, you're just mistaken again. Machine learning is a way of quantifying a phenomenon that you know exists. So if you start with something sensible and then try to use machine learning as a technique to help capture that edge, then fine. It has the same pluses and minuses as any other mathematical technique, but it's more difficult.
Right.
That's the thing. Most people don't understand linear regression.
Right.
If you don't understand linear regression, machine learning is not going to help you. It's just going to make your life more difficult because you're not going to understand that at all.
Right, right. Yeah, no, I think that makes a lot of sense, Euan. And I think, one way I think about machine learning is you can maybe use it as a tool, right, to optimize an existing strategy that you already have. But I think a problem with machine learning right now with trading is that there's this misconception, like you said, right? People will just take a Python course, a machine learning based course, and then assume that they can start trading the stock markets. I don't think it works like that, right? So that makes a lot of sense.
The most important thing about trading is choosing a good thing to trade.
Right. Something that you understand.
There's a saying in poker that the most important thing is finding the right table. So it doesn't. If you're trading the most efficient market in the world, like the US stock market, machine learning's not going to help you. It's still the most efficient market in the world. I mean, it's not. There's no edge there to get.
Right. Yeah. I think the question Dr. Chan and I were kind of debating, I guess, was more along the lines of, will there be like a major breakthrough, right? Like, in chess, for example, we discussed how Deep Blue came around and then started beating the best chess players in the world. This was like maybe 20 years ago, right? And now you have these chess bots that can, destroy any human player, right? And they're using proper machine learning principles. And so the idea was, well, could something similar happen in the world of trading with machine learning, maybe sometime in the future, right? But the difference there is that the markets are evolving, right? It's not like a stagnant game, right? And so the participants are always changing. So I think it's a different equation, right? If you think about the two concepts.
Yeah, I mean, every 10 years or so, you hear about some new technique that's going to change everything. Whether it's chaos theory or neural nets or expert systems And they all end up becoming perfectly useful tools, but they're never the answer.
Right.
Like there are options market making firms now that are using machine learning to optimize where exactly they place bids and offers and how they adjust things and things like that. And that's a way of using a tool to improve something that you know already works.
Right.
But the idea of using that tool to go and find some trading strategy, that's not the right way to do it. You've got to choose the right problem for the right tool.
Sure. Yeah. I wanted to kind of circle back to our audience, actually, right? So obviously a lot of our listeners are either trading, at the retail level, or they want to start trading more and more actively. And obviously you have like decades of experience trading options. Trading options is never easy. What are some mistakes that a lot of traders make when they start trading options? And again, I really wanted to kind of lean on you here because of the amazing experience that you have, kind of experiencing the market from multiple personas, right? You've been at the other end of the table as well. Now you're managing your own fund. You've kind of seen it all. So what are some basic mistakes that people make when it comes to trading options?
I think the big one is the mistake on the source of edge, where they will think that they think time decay is an edge, and it isn't. An edge is only something that the market doesn't know about. Everyone knows that time passes. There's no edge there. The edge is in volatility. So that is very dangerous because it means people will blindly sell options because time's always there.
Right.
But like I said, unless volatility is mispriced, there's no edge. And the next thing they do is they focus on the structure so much, like the exact strikes to do. Again, it doesn't really matter. It will matter on the P&L of any individual trade, but you shouldn't be thinking about that. You should be thinking about, I'm going to do this for the next 10 years. I'm going to be trading weekly options. I'm going to be doing 500 trades. At that point, whether you sell the 30 delta option or the 25 delta option, pretty much immaterial. There's no edge in that choice generally either. And finally, I think they trade too often. Every time you touch a position, it costs you money. And this whole idea of repairing positions, it involves a lot of trading. Conceptually, it's wrong, but it's not a free mistake. It costs you money. So sometimes you just have to admit, you know what, being short vol this week lost me money. That's it. I made a bet. I lost a bet. It's like you can't bet on New Zealand to beat England at cricket and then somehow manage to be wrong and still make money. It doesn't work that way. If you're wrong, if you're wrong, accept it. You lost money. Do the next trade.
Sure.
I mean, I think they're the big three problems.
Yeah. No, I love that because those are obviously very actionable, things that people can work on. And I loved what you talked about there. People trade too often. I see this all the time. A lot of newcomers start trading and they're taking maybe 10, 20 trades a day. And then they start wondering, why are they not making a profit? And so, that was really nice. So I think that, that brings us to the end of the interview, Dr. Sinclair. Thank you so much for today. I really learned a lot about how it becomes very important to really understand every person's role in the markets. I think that's the biggest takeaway I took from today. And once someone does that, then it gives them an opportunity to hopefully go about generating alpha and being profitable. My last question to you for today is, this is a question I ask for every guest. Where do you see yourself and Talton in the next 5-10 years?
Well, I should have mentioned this earlier, actually, but Talton no longer exists because I got sick of trying to raise money.
I didn't know that. Okay.
Our returns were fine, but raising money turned out to be horrible. I just hated it. So
Yeah. Yeah.
we just wrapped that up.
Oh, okay.
I don't know. In 10 years, can I say I'll be dead? I don't know. It's
Hopefully not. I mean, you seem like a pretty young
well,
guy, so.
hopefully not. But I mean, I've sort of retired twice,
Okay.
and then I found myself the next day waking up and trading options again.
Mm-hmm.
So I can't see any reason why that's not going to continue. I probably will be doing this forever. You know, I'm lucky. This is sort of my hobby, and it's my job. So that's kind of perfect, right? I get cranky at the weekends when the markets aren't open. So I guess that
Start
means
trading
I'm doing
cryptos
what
or
I'm
start
supposed
trading
to be
Forex,
doing.
I guess. But I know I didn't know that about
I
Talton.
trade crypto a bit.
Oh, okay.
Crypto, the problem with crypto is even if you want the markets to be open at the weekend, 24/7 is not fun.
Right.
Waking up at 2 o'clock in the morning to correct things, not fun.
There's just too much to do. Right. Now I've seen a lot of my crypto buddies. They're just always glued. But no, I mean, obviously, you know, when it comes to running a hedge fund, that's the issue, right? There's always these two things to focus on, which is the returns and raising money. And I know many people who went down that road, and obviously, you know, that happens. But I'm glad you're coming back to what you love, which is trading, and hopefully, you know, you'll still be trading 10 years from now, 20 years from now, and we can kind of experience, you know, how things like machine learning impact the markets in the future. But so yeah, on that note, you know, thank you so much for today. And, you know, I'll talk to you soon. Cheers.
Thanks very much. Appreciate it.